today. Thank you for coming. The smartest entrepreneurs and aspiring entrepreneurs are here today because what Kelley has to talk about is really, really important. Before I introduce Kelley, though, is there anybody who would like to stand up and give a pitch, an introduction, and have an act? This is the networking part of the Connect sessions. Anybody? Lots of great companies were formed by making connections, doing exactly that. So if you don't do it today, think about it. If you need a developer, if you need someone to help you with marketing, or you need someone to help you with whatever it is, design, this is a great place to meet them. So, all right, well with that, that's more time for Kelley. So, I didn't know I was going to do this until literally 5 minutes ago, but it's an honor because I've known Kelley longer than either one of us would probably like to admit. We worked together at Respironics, which is now Philips, dating all the way back to 1990, 1991. And Kelley is a Pepper grad, GSI grad from 1994. I would have guessed it was 1993. And then I followed her lead a couple years thereafter. She and I've been long-term friends for a long time. She is great in finance, but she has also done so many things in operations and human resources and different startups, which she may or may not go into in today's talk. She's here to talk to you about cash flow. And the first entrepreneur that I worked with used to have a saying that cash is king. And so if you are an aspiring entrepreneur, trust me, you will spend every day worrying about your cash, and how much you have left and how quickly it's going away. Mm-hmm. So I'm really excited to have you with Kelley. So thanks for coming.
Well, thanks, Bill.
Kelley,
thanks. Hello. Thank you. Of course, I now say cash is queen, but that's just me. Thank you all for coming today. I'll give probably just a minute or two more of my background, just to give context as to why you guys are stuck with me for the next hour. But then I want to move on. So as Bill said, we've known each other for a long time. What he didn't say, of course, was where I did my undergrad work, because he's just jealous. No. Anyways, I got my finance degree at Penn State, and after that I started working at PPG. From there, then I always knew I was going to come to get my MBA. The question was where, and I was fortunate to be able to come to Carnegie Mellon. I switched into the flex time because I was a smart finance person and cash flow person from the very beginning. Respironics said they'd pay for it, and I went, okay. So it was 3 tough years, but it was great. And what was great about it with, PPG, obviously great company, large company. I never lived in Pittsburgh. I actually lived in Meadville, New York, Kansas City. But Respironics really that's when I kind of found out what entrepreneurial was. We were 36 million in revenue. When I started, when I left, it was around 500 million or so. As the company grew, obviously it grew, it got larger. Bill and I actually worked on some some spin-out potential type companies. Timing wasn't right for the company, but it kind of caught that bug. And so the next, I've kind of moved around and did some different things, some in the more entrepreneurial, some larger, but the one consistent is each of the companies I've been with have been fast growing. And so with that, cash was pretty big, and we'll get into that a little bit more. But the one thing I always loved about being kind of in finance and business is I got to do different industries. So did medical, did engineering, construction, and coal, did voice recognition software, and a tech company in healthcare. So a lot of fun different things. As Bill also said, I have a lot of operational experience too. So I'm a business person. What you would never ask me to do is be that developer that some of you might need. Oh, I can type something up, but you're not going to like the result. But what I wanted to find out first from you guys is, and I'm just going to write it down. That's why I asked for the whiteboards, because one, as we're going through this, cash flow has been my life for a long time, so I can go many different directions. Obviously, I have a presentation, but as we get through, because I have a very practical part, I just want to be cognizant of some of the things that you guys are here for. And then at the end, if we didn't hit some of them, I just want to come back and address it. So kind of just throwing it out there. I just want to hear, why did you come here? Meaning, why did you want to learn a little bit more about cash flow, or what did you want to maybe get out of this presentation? So if anyone has it, I just want to jot it down.
Just to learn a little bit about the impact of debt on, especially startup cash flow.
Okay.
When it makes sense to take debt versus traditional equity based.
All right. All right. Okay.
Like how much cash should I keep in the bank and the remaining net worth for hiring, for example?
How much kind of cabin reserve?
Yeah,
Like,
right.
Okay.
Thinking about cash flow as a communications tool to kind of talk about financial position.
Anyone else?
What's the best way to track ongoing burn of your company in different cities?
Building off that, where companies in the past consistently go wrong or trends are seen.
Well, all right. Well, good. We had a good range. Some of these I probably won't hit on in great detail, but we'll be able. But everything on here, these are good questions to ask. They're good that these are things top of mind to you, and hopefully by the end you have a little bit more insight and some direction, and we can go from there. So thank you guys. And well, I'll get into it in the next. So one of the questions, and some of you have hit on it, when Dave and I were talking about, well, what should your topic be? We originally were talking about, with the sale process, because I've recently I've now sold a couple, not I, but I've been involved, and as a CFO, you're really involved with selling companies. And so I've seen the good, bad, the ugly, the hard, what you need to do, prepare for it. So we were talking about that, but then kind of realizing, but if you if you got to get to the sale, and how do you get to the sale? Well, there's many ways to do it, but the first one in an area that I'm quasi-expert in my opinion, is on the cash side. But what you'll see when we go through this kind of model that I have together, there's a link that takes you eventually to help you in preparing to eventually get to sale. Because one of the things, and I know anecdotally, that if you don't have good cash management, bad things can happen to your company. It's just somewhat intuitive. So and you guys can Google this, you can look it up. There's nothing rocket science about it, but I just kind of quickly, to confirm, so what are the top reasons that companies, fail? And, two that came up right at the top, and again, I can continue going down, but one was why small businesses fail. It's put out by score.org. They're counselors to America's small businesses. 82%, poor cash flow management skills, poor understanding of cash flow. 79%, start off with too little money. 73%, being overly optimistic about achievable sales, money required, and about what needs to be done to be successful. So some things you've all have already asked about. Another one I found was a white paper by Moya Mason, and they have 11 common causes for failures. Now, obviously some of them talk about we got to pick the right product, but What's also on top? Inadequate cash reserves, failure to adequately anticipate cash flow, uncontrolled growth, putting up with inadequate management. It all falls into it, and they kind of summarize and say, well, poor management is cited most frequently as the reason businesses fail. Inadequate or ill-timed financing is a close second. And so the reality is that's what cash flow goes into, good fiscal management is also a sign of good management. And eventually when you are asking for more money to come into the company and or hopefully you're getting to that successful sale, what are one of the things that people are really looking at? Yes, they want to see the product, they want to see that you have customers, that you have recurring revenue, et cetera. But they also want to know your management. And that goes into good fiscal management because then they know that the reports that you're giving them, the information you're sharing is good and it's reliable. Now, anyone here and I probably know the answer, but anyone out here finance, accounting majors or have experience in it? No. Okay, good. We have. Cash flow is easy. That to me is the most ironic thing ever, is that cash flow management always comes up as one of the number one reasons. To me, cash flow management is actually one of the easiest things you can do. Now, having said that, I'm not saying getting revenue is easy. I'm not saying being able to control customer payment or when things happen or are needed. But the management of it, the modeling of it, the tracking and the knowing, it's easy. It just requires work and it requires attention. So a little bit more just to kind of give some background. I talked that I've been at different size companies, but I've been doing this for over 20 years. And I've worked at bigger companies, I've worked at smaller companies. Obviously, the model that I put together was actually back as a result of many of you who are younger don't really, you kind of went through and saw what happened in 2008, 2009. But that's when I put my first rendition of this detail together because I was working at that time at an international company that is in construction and coal, which are very tough industries regardless. But during 2008, 2009, all money was stopped being spent. We had customers go bankrupt on us. So therefore then now they're not paying us, but yet I have vendors we have to pay. You have employees. So you have a lot of those things. And oh, by the way, at one point we then brought on private equity group. We had a fund. Eventually we had to sell. So we limped to a sale, but we got to the sale because when we had those customers declare bankruptcy, we went into this little group that banks like to call special assets, AKA the dog pound, AKA purgatory. You broke covenants, now you're on their watch list. And what they said is we need a 13-week cash flow. I'm like, all right. So I made one up and it worked, and they actually, this is PNC, so it was a big bank, they actually adopted it and had me share it with some of their other customers. It's very simple. This isn't, again, not rocket science. But at that time, we were a $400 million company. So we were we were growing fast, but this was important even at that size. And then most recently, I was at a company that was a CMU grad startup company called Careform. I was CFO there. Steve Fleck was our CEO. And I brought it there. And the beauty of that was we then got an unexpected call for a really good offer, but I already had all this stuff in place. So whereas, trust me, a sale process is not fun, but it's a lot more fun when you have your ducks in a row and you have the information and you're able to share it. So I've been doing this for a long time. I've done it at bigger companies. I've done it at smaller companies. We're going to go through this. A couple slides. We're going to go through it. I'm going to go through the details. It can be adapted. But my point is, regardless of the size company, this is what you need to do. And I've been there through the good, the bad, and the ugly. And the ugly sometimes is knowing what the answers are or seeing what's ahead. But as all of you know, is if you know something, you can at least act and do something with it. So let's get started. I know, one of the first things that many of you probably have done or will put together when you're thinking about starting up a company is a budget. And I know Phil Compton was in a few weeks ago, did budget modeling, and I'm sure you've had some in classes. Budgeting is extremely important because obviously it's not the budget result, it's the process that you do, and I'm sure you went through all of that. Is who are my customers? How many things are we selling? When are we selling it? What's the timing of it? How much is it going to cost? So when you put a budget together, that is usually step one. And for what I'm talking about here, you'd like to have one that is monthly. Because then what you could do is you may put together a monthly cash flow. And so when you take your revenue and you put, that revenue is going to come out in like 30 to 60 days. That cash flow is going to, or the AP is going to be paid out. And so you can have a very high level cash flow. And the good thing about that is you can then talk about your runway. You can see, all right, well, I have this much cash in hand. If this basic P&L kind of you shift it out 2 months, I'm just doing very high level general. And now I can see when I'm going to need more cash. That is good information to know. So if you're doing this in January and you're like, come October, November, we're going to probably start needing cash. So I need to be aware of that. I need to watch that. That's important and good things to do, good to know. But what we're doing today and what we're going to be talking about now is the 13-week cash flow. It's a quarter. If you don't know why I picked 13 weeks, it's a quarter. And the reason why, as I told you, one, like when we got into trouble, that's the thing the bank asked for. But the other beauty is in 13 weeks, you should kind of know what's coming. You should kind of know what cash is actually coming in because you should have signed contracts, you should be invoicing. You either have employees or they're coming on board. So the 13 weeks is that very tangible, it's right now. Because a monthly is nice, but guess what? That doesn't talk about, I got payroll every 2 weeks. I got rent, health insurance, corporate insurance, all due the first of every month. I have this timing, this timing. This is good generalities. Now we're going to have fun and get into the details. So we're going to go through this. And the one thing that I want everyone, so what I have done is I have I've put together kind of a model. Again, I've stripped all the names away and I've done all of that stuff. This was one that I actually used a couple years ago and I've added some different things. I also have this one called pre-revenue that's taken away some of the information. But the bottom line on this is I'm going to first go through how it's set up so you can understand all of that. And then we're going to go through it. And I want you guys, as we go through each of these columns, each of these rows, ask questions. What if, why, all of that. Because again, this is not even second nature to me. This is like breathing to me. And so I need you to make sure you understand. Now, at the very end, there's nothing, again, this is something I've created over 10 years ago and I keep tweaking and adding on. But this is a tool that if at the end this is something you're interested in, I have no problem. You can have it. Because again, there's nothing, it's Excel for crying out loud. There's nothing different, but there's a lot of rich and good information on here. Can you see that? Are you guys okay from seeing? All right. So basically, again, it's a 13-week rolling cash flow. Again, what we talked about, the 13 weeks, because it's tangible, it is what the banks and other people will use. It's rolling because what I usually do, and so what I tried to do here is close this, is say like this would kind of be real life, meaning that if I was, this is your company right now, we're coming up on, week ending, well, it's next, I basically said through the end of February, so that's like next week, and then what I have hidden is actual. So even though it's a 13-week rolling, I never drop anything because then at the end of the year, you have an entire year's worth of information. And at the same time, I'm kind of collecting some of my year-to-date, my monthly, so I can do some burn rate information. So just to go through the setup. Over here, and we'll get into this, I have forecast, invoiced, received, bold. You can see how I have those fonts. That's related to how I have the fonts in here. It's a communication because Forecast just means that's everything we expect to happen. Invoiced, the reason why you want to know if something's invoiced is, let's say, for example, we have, at the end of March, we have a payment coming in. It's not invoiced yet, but yet that customer is a net 60 pay customer. Well, how the heck are you getting money in 30 days? So that's what the forecast means. Invoiced, then you're looking out, you see things are invoiced, received. Means cash came in, yeah.
So for each of these items, as they change, you're changing the fund.
Yes, yeah, and we'll get into kind of the process of this, but that's exactly right. Yeah.
So for your accounts receivable, because it's net 60 or net 45, which week do you drop that?
So normally what I do, so when you are invoicing, so if I'm forecasting out, so let's say I'm on January 1, and normally you invoice the first week of the year, let's say, I will count out those numbers of weeks and then add one more, because I'm a finance person, which means I'm conservative, but I'm also doing my own AI, because as I get paid, I start learning how they pay me, and then I will adjust forecasted ones. But right, you can see that, so my start with, this is what's telling me all of it, telling me kind of how I can read my numbers. Then I get into cash in, so the first one we'll talk about will be customers. So what I do is I list out every customer, and this would normally be your name. So whatever I'm not creative enough to come up with Acme 1, Acme 2, so you got customer A, B, and C. I show the net payment terms. Again, it's information so that when you're looking at this, because you may not be the one doing this, you may have an accountant, you may have someone else. So you want to be able to look at that and quickly see what I just said was, well, wait a minute, you have something being paid here. It's, 30 days away. It's not invoiced, but yet they're net 60. So this is telling, so this first group is all your cash in. And I know you had did you have a question or? Okay. So starting first, we have the cash in. So you have this whole, all right. I do this all the time, but how do we, hold on. Okay, seriously, this is embarrassing. How do we hide the ribbon at the top? Do you know? I know I do it by accident. Do you know how to hide that up there so I can pull everything up? Right here, thank you. I always hit it, there we go, thank you. You'd think I would know this, but I work on such big screens that I'm never like. So we're starting with cash in. So my cash in, you can see I have customers. I have miscellaneous, because there will be miscellaneous things. You put a deposit in, you get a return. So again, it's miscellaneous. You have bank fees, because if you have a bank account, you're going to probably have bank fees. You might have interest income if you have a savings. I've also tried to recognize that you get other cash in from investors, from equity, from other. So what I've tried to show here is this first group is everything that you could get cash from. The column next to it is contract. What I've done here is I'm trying to show you, and this is something, again, in preparation for a sale, in preparation for bringing in more money, they want to see contracts. So all this is doing, again, you as an owner, do you have a file? Is there an actual tangible, whether it's soft or hard, file to make sure that you have the contract? So this is just really kind of a one-time deal, but it's really confirmation that, yep, I have it, I know where it is. Because at one of my prior companies, the CEO said to me once, and his name will remain nameless, he goes, next time I start my next company, I'm going to hire someone and give them a bat, and their sole purpose will be anytime I sign a contract, hit me over the head if I don't put it in a file. Because when we were going through said sale, we were going through emails, file everywhere just to find random things. It would be much easier if it's like, oh, look, customer contracts. Nice. So first we have the customers. And then again, we're just going to go through setup first. So then that's your cash in. Now you have, shockingly, cash out. I didn't say this in the beginning, but this is clearly not a statement of cash flow that you see in an audit, that is a statutory report. That's correct. This is an operational, tangible report that you can use and others in your company can use. However, it's cash in and cash out. And if you look at a statement of cash flow in your accounting group, it's sources of cash, uses of cash. So it's really the same type of thing. So now you have what cash is going out? Well, what's the first one that you have? Payroll. Now, what I have usually do at small companies, because it's just easier to have it, I will list out all the employees. Careform, we went from 29 employees up to 200. I can tell you, yeah, I did not do that because I saw what payroll was and I just had a big dollar amount, and then I would maybe do a calculation off to the side when I knew we were hiring a lot of people and add more. But if you're a smaller company, this might be something that you like just because it gives you that information. But this was also another lesson learned. When you're going to sell a company, do you have agreements for every one of your employees? Do you have non-disclosure agreements signed? Because let me just tell you, if they're not signed, yeah, they will want it to be signed, and then you'll have to pay them for such signature. You do not want that. You want all this stuff up front when you're hiring them. So again, you can add whatever, but what I'm trying to do here is recognize that when you're starting up a company and you're hiring these people, yeah, not only are you paying them, you do actually have documents that are legal documents and are things for your own security. So that's all I'm doing here is saying, yeah, let's just make sure that you have all of this. So here I have employees. I know a couple employees that I'm hiring in the future because we already have offers out or they've accepted, so I'm able to put them into. And then I know I have, maybe I put in my budget bonus. Now in this case, I've already paid the bonus because here's a little accounting. If you want to get the tax credit for bonuses in the prior year, for prior year work, you have to have them paid out by March 15th. That's a little FYI. You can pay them out any time in the year, but if you wanted to get that onto your tax credit in like the calendar year that it was earned, it has to literally be paid out before March 15th. So that's just a little something to keep in the back of your head. No big deal if you don't. Just you get tax credit next year. So these are the employees. Next, after employees, we have vendors. Now, with vendors, I've included shareholder distribution and tax payments. I know technically those aren't vendors, but it's still it's a non-employee payment out. You have all your bank debts, payments, expense reports, credit cards, other miscellaneous. And again, we can go through all of these, but what I try to do is identify any type of vendor that you might have. So you have your regular vendors, you have kind of the ones that are monthly with rent. These are the vendors that would probably be more along your cost of goods sold, your marketing, training, whoever. And again, I put names in there. So on my list, I literally show names, and we'll talk why later. And then we have CapEx vendors, and I only keep that separate. On here, again, you don't have to, because sometimes eventually I just put everything alphabetical because it's easier for me, but for today, I just wanted to show different categories to make sure that you see and I'm recognizing each type. The reason why I have CapEx separate from up above is because eventually if you try to reconcile against a budget, CapEx is part of depreciation. It's not a straight on expense. And then down below we have contractors, because I also know we always had them, but I know especially with startup companies, you usually will have contractors because you don't want that fixed asset, if you will. I mean, it's not asset, but fixed human resource in case they're not needed for a longer period of time. And quite frankly, because sometimes those are specialty and they tend to be a little more expensive, so you really can't afford them 40 hours plus a week, but you can do 5-10 hours. So we have in here then, so then just like I did in AP, do you have the contract? Do you have a W-9? So some of these you can see NA next to, but again, thinking 2 reasons. For contracts, you want to make sure with vendors you have contracts, and you can go on and on. You probably will need NDAs with them. Other types of agreements, not only non-disclosure, you might be, depending on what you do, some invention disclosure and ownership information. So with each one of these, especially when you get down to contractors, again, this is just a way to make sure in your filing system, if you will, you have everyone accounted for, because unfortunately, things happen, and when things happen, you want to make sure you can find that contract that you both agree to. So we're not talking about, I'm not presenting today about terms because I know you have legal seminars that talk about it, but you want to make sure that you have all of them and you know where they are. The W-9 is especially important when it's coming to, many of them, especially when you're dealing with lawyers and accountants, but contractors. You definitely want that also. Now, there are 2 types of contractors. I might hire Will directly, and he and my company have hired him, or I might hire, IT Solutions Inc., who happens to be a staffing agency. We can get into preferences because everyone is different, but you want the W-9. The W-9 is because you eventually have to pay them, and so you need to make sure you have the Social Security number, make sure they're legal to work, et cetera, et cetera. So what I've tried to show here then is that this cash flow, you can see then, this is your entire company. This is everything that's happening within your company. This is all the money that's coming in. These are all the people that you work with. These are all the people who work for you. So this is a snapshot of your entire company. And again, whether it's you doing it or someone else, someone needs to be looking at this. And then you as the owner, CEO, founder, you need to understand it, see it, and to review it. So that's the general setup. You can see I have week ending. And then at the very bottom, again, under lessons learned over time, you figure out, here's my estimated cash balance. And I shrunk it. And we'll talk about, I see how I have some negatives in here. I want to show you some different things that we can do, but this can be a very real, because what we're talking about is timing of payments. The next thing that I'm trying to show is you may have a line of credit. So I put stuff in here to show how we're tracking against a line of credit. And then, oh, by the way, here's another thing you can do is you can balance it against your checking account. Good management, just make sure and obviously the reason why is, 1, you want to make sure that you've captured everything up here, that something didn't hit your bank account or did not hit your bank account as expected. And quite frankly, if you have an outside person's involved, you just want to make sure, that you have trusted confidence in everyone doing it. So it's just making sure that you're, I don't know why that, I must have, this should be 0. That's my fault. I'll have to look at what I did on my formula there. But anyway, so I do that. So usually, and we'll talk about that, is I would pick one day every week, and this was something that I did or one of my employees. You just do it every week, and it's just done. The setup is the hardest part. Maintaining it is actually not hard. And, well, because I'm weird, it's actually kind of fun for me. And mainly it's because that means everything. I like when things check out and things balance and everything makes sense to me. So this is the general setup. Off on the side here, and then we can get into kind of details, is I also then show some, because we talked about like some monthly burn rates, et cetera. So what we also do, well, it's a combination of looking at the burn rate, but also very often, especially when you set this up, you also want to do reconciliation back to your budget, just to make sure that what you think is coming in is that, or what you're forecasting to come in for the quarter is what you had put in the budget, and if not, why. And this will at least, when you put your budget together, you would have put where you think your revenues and costs are coming from. So you have the estimated monthly, and then I usually have notes off to the side. The other thing you probably saw is I do a lot of, the inserting comments, because, for example, on this one here, like I'm saying like, oh yeah, that was a big dollar amount. Well, yeah, that was a down payment. So I will, again, this becomes your own document, but by doing this, you then have the snapshot of everything. And because you're going to be busy with 3 million other things to do, the beauty of putting these notes on is so you don't have to try to remember. Or when you hand it off to someone because you've now hired an outside accountant, or when you're trying to bring an investor in, everything is right here. You don't. They can be a little bit more self-sufficient. And then I think that's about it on the layout. Yeah, so then I have places for notes, just some different things, when I'm going through kind of reconciliation. So that's the overall kind of setup.